Hey everybody, Andy Moss here, tradingadventures.com, and it's Saturday morning, which means it's time for a trip through the weekly charts. Let's take a look at the market action over the last week and see how the message is evolving. As always, the goal here is not prediction, it's to read the price action and listen to the message of the market. If you like these weekly chart analyses and find them helpful, you can follow along each week on trading-adventures.com. And I share additional charts throughout the week on X at Andy__Moss. And with that, let's get into it. I've got the stock index futures roadmap chart up here. Now you can see the short-term time frame is lower with a series of lower lows and lower highs below declining 5-day moving average across the board there. So the market has been pressured. It's continuing to follow the trend lower, and we don't see any evidence of that changing yet. So for the last couple of weeks, I've been talking about the cracks beneath the surface as we started to see things show up that were looking a little troublesome, even though the indices were still very near their all-time highs. In the last couple of weeks, those cracks widened and became more visible, and this week we're watching that weakness accelerate lower, as here we look at the SPY below its 40-week moving average or 200-day moving average there, and not by just a little bit. It's come down here a good bit, and this anchored VWAP has been on the chart for quite a while. This is off of the lows of last April, and it looks pretty likely that we're going to test that now. And if you recall, I first started pointing out this extension level several months ago. And at first it was just a reference point, and then we kept bumping up against it, and then we couldn't close over it, and then we started drifting away from it a little bit. So just to recap the progression here, this is not a surprise event that came out of nowhere, and I don't mean to suggest that anyone can predict what's happening next, because we know that to be false. But when you follow the price action and listen to the message of the market, you can see these things evolve and adapt along the way. So that's what we're doing here. RSI down in the lower half of the range here, and volume has been well above average on this selling. Looking at the Qs, of course, we have a similar situation here below the 200-day or the 40-week moving average. This consolidation area here, which I pointed to earlier in the week, had given way and opened the door to more downside, which we're now seeing. And we have, like the SPYs, we've got this anchored VWAP off of the April 7th lows of last year, and it looks very much like we'll probably reach that level. We could also tie in another slight reference point here. Let me make sure this gets in the right spot. This was the low back in November last year, and so we bounced off that just ever so slightly and closed above. So it's not a magic line. There's nothing incredibly telling about that level. It's just a reference point on the way. And RSI in the lower half. Volume has been higher, but backing off a little bit. DIA, we talked about its leadership position for a long time, and then noted that this has now become, or is confirmed as, a failed breakout attempt. Got right up to this same extension level and then just sold off really hard. It's below all the moving averages. It's below the anchor off of the April 7 lows, and very close to testing this level around 451, which was a high back in December of 2024. And that was a pretty important level. It got tested many times here throughout the following year or two, and really took some building before we could get prices above there and stay. So if that was an important level on the way up, maybe it'll be an important level on the way down. We'll have to wait and see for sure, but I do think it's worth keeping an eye on. IWM also had a position of leadership that just kind of stalled up here and started consolidating, going sideways. No lasting buying pressure on new highs, and now we've seen it come all the way down through the anchors, below the moving averages, resting right on the 40-week moving average here. It has not yet hit the anchor VWAP from the April lows. That will certainly be a reference point in the coming weeks. And we also have a previous high back in this area of November of 2024 that is, if we look at the closing highs on this candle, that's very close to where price closed this week. So that's a reference point. Maybe that adds to potential support at this level, but certainly don't know that to be true yet. Bitcoin's tried to rally and came down, touched its sharply declining 10-week moving average. It's still stuck between this anchored VWAP from this kind of failed breakout here and holding up, but certainly not changing the trend. A lot of work yet to do for Bitcoin before it could make any meaningful change. Moving on to the US dollar. Continued consolidation here at a higher level than recently. We've got a decent rally here off of the January 26th weekly candle. That was showing a rebound there from an area of previous lows that has developed into a decently sustainable rally here for the dollar. It's back above the 10-week and the 40-week and into this shaded area, which has been important for many years now. Lots of meaningful lows in here and recently a few meaningful highs. So we'll see if that happens again. It's testing the anchored VWAP off of this high from back in January of last year, and that's an important reference point. Don't expect any giant moves either way from the dollar, but more consolidation in this range seems to be the likely outcome. Moving on to the rest of the world. Wow, talk about failed leadership. This was an incredibly strong trend that was just grinding slowly higher for a long time, and now it has gone from new all-time highs to correction status in just 3 weeks of selling. So the overseas market's taken a hit there. It's back below the 4-week, the 10-week, these anchors here, and right in this area, just below $66. We've got the 40-week moving average, and once again, the anchored VWAP off of this April 7th dip. RSI is down in the lower half. Volume has been well above average, and some excitement there in the overseas markets. We'll see if it can find some resistance here. So some common themes that keep coming up. Notice these extension levels. This one not exact, but it's still in the neighborhood. These are the kinds of things that you never know when you put them on the chart in advance if they're going to become relevant. But I do think it interesting when you see them show up again and again. And the same thing with this anchored VWAP off of the April 2025 lows. Who knows if that's going to be support, but it's on every chart and price is testing that now. So it's a level of interest. We'll see if it matters or not, just like we'll see if the 200-day moving average matters or not. The moving averages are not support and resistance. Did we stop here last week above the 40-week? Yeah, but it didn't mean anything this week. We're well below that on the SPY now. So getting back into the rest of the charts here. China, similar action, below all the key moving averages, below the anchored VWAP. It was not support. These Fibonacci levels on here really don't mean anything right now. I can probably just take those off the list. RSI is not in the gutter, but it is down here around 35, and volume's been chugging along like this is just business as usual, which it is. It's a market in a downtrend. And so you see some acceleration, you see some consolidation, you see a resumption of that selling pressure. That's what markets do. Bonds have not been the safe place to hide. The buying rotation that was going into the bond market has swiftly come out. And now not only is this another failed breakout like this one back here, like this one in October of last year, now we've got another failed breakout. We're below all the moving averages, below this shaded area of price history, below this trend line, below everything you can look at on this chart that was a reference point. None of it was support, really. I mean, you had some price consolidation and support in this area, but on this sell-off, there is no support. It's been straight down for 3 weeks. So We'll see if bonds can moderate and slow down, but no signs of that yet as they sell off sharply for 2 weeks in a row and close on the lows this week. TLT, same kind of picture, little different chart, failed breakout, now down below all the moving. This level of congestion, just look at all the garbage in here on the chart. I still haven't cleaned this up, but I need to do that because none of these are really relevant. Let's just take them off. They were reference points and they did not seem to have a whole lot of meaning on this chart. So let's just get some of this stuff out of there. We did have some meaningful holds or reversals in this area around 87, but that is broken now. And the next potential point of reference is just below 85, followed by down here 82, near 82.50, which goes all the way back to this sharp low, which occurred in October of 2023. So that's the Treasury market, high yield market, still trading like stocks, and which it always does. I could probably stop pointing that out, but not even a breakout attempt. We saw first it lost this trend line, then it chopped around here sideways and could not make any higher progress. And now we've got 3 weeks of sustained selling on very high volume that's taken the high yield market down to nearly oversold levels. Not quite, but getting pretty close. GSG, the commodities, holding up very well. And of course, remember that this is a very heavily oil weighted index, so no surprise there. It's very overbought by RSI measures, which when RSI gets overbought and stays overbought, that's very bullish. Last week's bit of a hiccup was quickly resolved as buying pressure kicked back in and kept the prices high. Here's oil specifically, the oil futures, just a stellar move off of 55 up to more than 100, actually hitting nearly 120 last week. So oil is a volatile market, no stability there to speak of, although the price is holding up pretty well, well above the sharply rising upper Bollinger Band. And this expansion will certainly give way to some contraction at some point, but no way to know when that happens or to suggest that that happens next week, as the action continues to be very much driven by geopolitical pressures and headline events. So looking at gold sold off for the 3rd week in a row. It's this last 2 weeks, it was kind of the sellers testing, seeing if they could gain a foothold. Buying pressure was still evident, and now this week we see a pretty sharp decline down through a couple of Fibonacci levels here below the shorter term moving averages, still well above the 40-week moving average, but testing this anchor off of this little dip back here in October of 2025. We've got some corroborating factors in there, some recent highs, Fibonacci retracement. Again, that's not support, that's a level of interest. We'll see if it becomes support. We won't know that until after the fact. Silver, similar move, a little sharper selling, and down here in the lower half of the Bollinger Bands, below the 10-week and the 4-week. RSI is just now back to the 50 level, so there's a chance that that holds. We kind of hit the brakes. If you see this weekly low, right in the neighborhood of this weekly low. I don't have an anchor off of this slight dip, but we can put that in there. We're below that, so that doesn't look extremely relevant for this week, although it did a little bit of a bounce from it a few weeks ago. And we'll see if silver consolidates and gains a little support, a little stability. Does it continue lower next week? These weekly chart breakdowns they're about reading price, not predicting it. These reference levels matter, but they're never guarantees. They're just levels of interest. As we look at these relative strength relationships, we notice that failed rallies tend to matter more in weaker environments. And with all of these charts, we see prices getting lower. Remember that cheaper doesn't automatically mean better value or attractive. We have to watch the price action and see what the balance of buyers and sellers are telling us. Who is in control? IWF versus IWD. This is growth versus value. 2 weeks of selling here after touching the declining 10-week moving average. And this is the potential event I've been pointing to for a couple of weeks now. We've seen this many times when the RSI gets to an extreme level. The first time, it's often followed by a second occurrence before we've seen a meaningful reversal. So no prediction, but a potential outcome that I'm watching for is another dip down here in the favor of value with another oversold RSI level before we see a meaningful return towards growth. That's just one thing to look for. Consumer discretionary versus consumer staples. The relative chart is holding up right here in this bearish consolidation pattern. I would not be at all surprised to see a resumption of a move in favor of staples. We've got 3 long upper shadows here for the last weeks showing that this slight progress higher has not been sustainable. We do have basically a flat or slightly rising 4-week moving average, but just to show you independently here is the discretionary sector, and here is the staples. Really sharp selling there, as at first people started positioning more defensively, and now that's a relative term if you consider staples to be more defensive than discretionary. But now it would appear that positioning is going even more defensive, leaving both of these sectors in concert, or maybe even altogether. So that is your relationship between staples, discretionary, and staples. Looking at high beta versus low volatility, this is interesting because we actually see a slight shift back in favor of the higher beta allocation here. So it's certainly not a meaningful turn at this point. It's testing this declining 10-week moving average, but a little bit of a curious bounce there this week as we saw a move towards safety in so many other areas. So now we'll move a little more quickly through some specific areas of the market. The semiconductor index is still holding up better than most. It's been trading around this anchored VWAP, the orange line here off of the November lows, and it's below the 4-week and the 10-week, but it's still in the upper half of the Bollinger Bands. The RSI is still in the bullish upper half. Volume has been about normal, and semiconductors are still holding up fairly decently as a collective group there. Biotechnology, on the other hand, is starting to round over a bit here, and looks like this selling pressure is continuing to build as we see maybe this develops into a topping formation, maybe not, but we're below the moving averages. We're below this anchor from this little dip back in November. We're in the lower half of the Bollinger Bands. RSI has a similar rounding top formation up here for now, and volume has been right about average. So would not be surprised at all to see further selling pressure show up in the biotech sector. IGV, the software sector that everyone's been watching, we watched for a bounce. We got a bounce, and that's all we've got so far. It's not a reversal. It's not a change in trend. It came right back up into a logical area where sellers resumed control and started pushing back the price back lower. So it's below the moving averages. Fix this chart a little bit here, and a little bit of a remedy here in the oversold RSI, but it's heading lower again, and volume continues to be above average. So not out of the woods for the software sector yet. Mag 7 is a group below all the moving averages, below the anchor off the April lows, and closed below this high from December of 2024. Notice that wasn't a weekly closing high. That was just the intra-week high back in late 2024. The closing higher closes were down in this area. So look for more movement lower on the Mag 7 as a group, and individually, just very quickly, Apple testing its rising 40-week moving average. Amazon still choppy in a bearish consolidation pattern. Google, same. It's trying to hold this anchor, but really not doing a very convincing job of it. We've got the 40-week down here around 263. Meta, big news this week as they shut down the metaverse. So Do they change their name? Do they change their business approach? They've already done that, but we'll see. We've got a little bit of a reference point here from this low back in November of 2025. And if this doesn't hold, then we'll see price action potentially down into the lower 500s or upper 400s would be the next kind of area to watch on Meta. Microsoft, very similar to the software sector, which makes sense, but selling off harder. It's just not finding any lasting buyer control here. NVIDIA, they had earnings. The results were good. It couldn't stay up. It's back down, testing this area around the lower 170s, and still in a choppy sideways mess, really, which it's been for 9 months or so now. Not breaking down, but certainly not making progress higher there. And Tesla is picking up some steam on the downside, accelerated lower below this rising 40-week moving average, testing this high from back in May of last year, and not looking good. So before we get into the breadth and participation measures, I want to show you one more group of names here. These are the different S&P sectors, and I want to start with a couple important ones because for a long time, as everything else was selling off harder, we saw things like industrials and materials taking the leadership baton. That situation has changed, and this very strong pronounced rise up has now given way to a quick move back down, erasing almost the whole move there. That is XLB, the material sector. If we look at the industrials, same thing. The move higher wasn't as sharp or pronounced, but the sell-off has been equivalent and has almost erased all of that progress that was made over the last several weeks. And then if we look at the rest of the sectors quickly, communications breaking down below a 40-week moving average. Energy is the one standout, which makes sense. If we've seen the incredible relative strength and absolute strength in oil, XLE has been the one sector that continues to hold up and attract more buying. Financials, weak and looking like they'll potentially move lower. Technology, not much going on there. We do have some DeMark 9 buy setups printing this week. Those are context. They're not a signal. It's just something to be aware of. Sometimes the turns happen pretty exact, but not always. So this is just a reference point. Again, not a predictive indicator at all. Just something to be mindful of. XLP, there's the staples we already looked at back down here in this choppy sideways range, with basically flat, slightly rising 40-week moving average there. Real estate had also been somewhat a level or an area of leadership. It's breaking down now and below the moving averages, back in this range. Utilities, same kind of story. Healthcare, really nasty move here over the last 3 weeks of selling. And here is the discretionary sector. We already looked at that as well. So now let's look at the breadth as judged by the percentage of S&P 500 stocks above a 50 and 200-day moving average. Continued downward motion here, and the number of stocks, the percentage of stocks above a 200-day moving average is now below the second week in a row, below the 50% level here around, 43.93%. Interesting thing, what I want to note is that the percentage above a 50-day and getting close level, down below about 20%. And we consider that kind of a washout. Once the selling takes this number down so far, it's not uncommon to see a bit of a reaction higher to kind of alleviate that pressure. It doesn't mean or predict meaningful reversal or lasting reversal. We can see back here, it was just a little bit of a pop, but this was really a much more healthy market. After this stronger sell-off, it did get washed out and then went back up very quickly as this rally started to take shape and the beginning stages of what would be a multi-month rise. So that is just another layer of context, something to pay attention to there on the S&P 500 breadth. Now let's go over to stockcharts.com for our point and figure charts. And actually, I will include those charts in the show notes, but the results show the continuation of the downward columns, the columns of O's on all three of those, and the SPX and NASDAQ 100 are in the mid to low 30s. The NYSE bullish percents hold up a little better, but still in a decline there and not yet towards washout levels. So something to watch on those. Again, I'll put those in the body of the article here down below the video so you can reference those. So looking ahead to next week, we've got a pretty slow and normal calendar as far as earnings and economic news. I don't see any major earnings reports coming out, nothing that jumps out at me. The economic news is pretty run-of-the-mill with some manufacturing numbers, some crude oil inventories. That'll probably be the biggest headline that comes out of the announcements next week, and jobs data, that kind of thing, but nothing that seems to be incredibly, or has the potential to be incredibly market moving. So putting it all together, what does this all mean? Now what? The message for several weeks now has been potential caution. Go slow, be patient, and do less. And so far, that message has not been invalidated. We've seen the high-level consolidations give way to lower prices. We've seen sellers engage and activate, driving prices lower still. And it doesn't look like there's any technical change to be gleaned from these charts. It's downward motion. It's resolution lower from bearish consolidations patterns. It's increased velocity or intensity of selling. The only thing that will provide some relief next week is positive news out of the Middle East, which we got some hints of that late yesterday afternoon. Do we get a big gap up in the futures Sunday night and in the markets on Monday morning? Who knows? That is a possibility. Does it mean that the bottom is in and just start buying the dip and it's back to good times? Absolutely not. Those events take time. They're a process. There are even a V bottom turnaround is not something that you can just pick out of thin air. These are things that we have to watch. And if we go back over to the shorter time frames, this is where we will find evidence of that happening if it were happen to show up. We see, do we go back up and test these levels? This is the 1 hour chart on the stock index futures. Once again, we've got several reference levels here on the S&P futures. We've got an anchor off of this recent high sitting around 6650. We've got the declining 5-day moving average sitting around 6700. So if we're going to see a meaningful turn, it will evolve like this. Price will come back up. It will either test or blow right through these levels of interest. Does it stop and turn around and head lower? If so, that's a message that we want to listen to. Does it blow right through them, or does it get above and come back down and test from the upper side? No matter the case, what we want to see is a series, a beginning and then continued series of higher highs and higher lows that eventually get back above a rising 5-day moving average. That is the first part of a potential turn sequence that we can be on alert for. Then we can look at the daily and the 30-minute charts. Do we see the same thing happening in the index ETFs on this 30-minute time frame? I can show you this version of the roadmap. Here's the ETFs on a 30-minute chart. Again, same information, little different lens. Steeply declining 5-day moving averages. Lower lows and lower highs create a downtrend. Can we see that change? Can we see a evolution into a sequence of higher highs and higher lows? Does the 5-day turn around and start to rise? Do we see that sequence of higher highs and higher lows continue above that rising 5-day? Then can we start making some progress on the daily time frame and then into the weekly time frame? Those are just, it's not anything incredibly telling. It's just the sequence of the market that we can observe and see what's happening. We're not trying to guess what's coming next. We're trying to stay aligned with what is actually happening. So that's the story of the market on multiple time frames there. We focus on the weekly charts, but we've seen some different time frames here, and that is the message. Continue to be cautious, continue to be defensive. Cash is a position, patience is a strategy. Don't be in a rush. See what happens, listen to the message of the market, and adapt along the way. So, one more time, that's where things stand for now. We'll see what next week brings. We'll see what the headlines are. We will continue to read the evidence as it develops. Continue to go slow, manage your risk, and let price lead. If you find these weekly chart analyses helpful, you can find written updates on tradingadventures.com. I also do the same on X at Andy__Moss. So thanks for following along. That is this week's edition of the weekly charts.